Hey guys, Nick here from Nick's Taxes, and welcome back to another video. In today's video, we're going to talk about how taxes work for individuals. Now, individual income tax is something that we're all subject to and something that we all pay. However, not many Canadians know how our taxes work or why we pay what we pay. Yet, in school, we learn about the mitochondria and how it's the powerhouse of the cell, but not many of us know how we get taxed and why we get taxed. So in today's video, we're going to buckle up and do a crash course on taxes. We got a lot to cover in this video, so let's jump right to it. So our individual income tax started in 1917 as a temporary measure to help fund the war. Well, the war ended in 1918, but the income tax continued because the government said they still need to cover for certain expenses, such as the veterans' pension amount and debt interest that it's accumulated over the year. Well, the income tax stuck around for another year, and another year, and another year, and eventually it was 1948. And by that time, the government finally admitted that the income tax was here to stay. They officially removed the temporary tag off of the income tax. And now that leads us to one of our favorite sayings: there's nothing more certain in life than death and taxes. I guess the government couldn't stop saying no to that consistent revenue stream that it was getting from its people. To show just how much the Tax Act has evolved over the years, I'm going to throw up a couple pictures of what the Tax Act originally looked like compared to what it looks like today. Pretty crazy, eh? So let's fast forward to today. For the tax year 2019, our taxes are due April 30th of 2020. A tax year is the same as a calendar year. So for tax year 2019, taxes are from January 1st to December 31st, 2019. So any income that you earn during that time period would be included in your 2019 tax return. So a tax return is basically reporting the amount of income you earn during the year and then saying that based on that amount of income, you owe this amount of tax. Most of us pay taxes little by little over the course of the year. And by the end of the year, we file a tax return to say we paid this amount of tax on this amount of money. We'll claim that we paid more tax than we actually needed to and request a refund. Or some of us paid less tax than we needed to and will pay more tax on April 30th. April 30th is just the deadline to square up on your taxes. Now, unlike some other countries, there's no opportunities to request a refund in filing your taxes. Taxes are due April 30th. However, late penalties and interest are accumulated on the tax balance owing on your tax return. So if you find yourself in a refund position, there are no penalties on filing late. Now, Canada has two types of taxes. There's a federal and a provincial. Everyone is subject to the same federal rates, but your provincial rates vary depending on which province you are subject to provincial tax in. Now, how you determine that is where you finished the calendar year. So for example, if you spent most of your time living and working in Ontario, but by the end of the year you moved to Alberta, you would be subject to the Alberta tax rates on your tax return. Now in Canada, we have what's called a progressive tax system. That means the more money you make, the more taxes you'll owe. And we have in Canada what's called tax brackets. I'm going to put up a picture of those tax brackets here. As you can see, the more money you make, the more taxes you have to pay. Let's say, for example, you earned $100,000 of taxable income. You'd be subject to that 26% tax rate. It's important to know that not your entire $100,000 income is subject to that 26%. Think of the tax brackets like buckets. You fill up the first bucket and then you move on to the second bucket and so on and so forth until your income is exhausted. So only a portion of your $100,000 will be taxed in that tax bracket. It's kind of complicated to explain without the use of an example. So let's dive right into one. It's important to note that because everyone is subject to the same federal rates, we're only going to calculate federal tax for this example. We're not going to include provincial tax. Provincial tax obviously varies depending on which province you're in, but calculating the provincial tax works much the same way. So let's assume we have a taxable income of $55,000. The first $48,535 is taxed at 15%, the lowest tax bracket. That works out to a tax of $7,280.25. The remaining $6,465 of income is taxed at the higher rate of 20.5%. That works out to $1,325.33 in taxes. This means that the total federal tax owing is $8,605.58. It's also important to note that these numbers do not take into consideration any credits or deductions. Now, there are many tax calculators you can find online. You don't have to do all this work yourself or by hand. One of my favorite tax calculators is the EY calculator. It gives you all the information you need to know. For example, let's take a look at the average tax rate here. The average tax rate is how much of your income is actually going towards taxes. The marginal tax rate is how much you would be taxed on any additional income. It also shows the marginal tax rates on capital gains and dividends. We'll get more into that later on in this video. The other nice thing about this tax calculator is that it factors in the basic personal tax credit every Canadian is entitled to. So, speaking of tax credits, we learned how income is taxed, but is there a way that we can reduce our income and pay less taxes? Well, yeah. There's things called tax credits and tax deductions. Tax credits are available both federally and provincially. You'll be glad to hear that they help reduce the amount of taxes you owe. Now, there are two types of tax credits, refundable and non-refundable. Non-refundable tax credits reduce the amount of tax that you owe. In order to claim a non-refundable tax credit, you must actually owe taxes. So if you have more non-refundable tax credits than you do taxes owing, it'll only bring your tax liability to zero. It will not put you in a refund position. So for example, if I owe $2,000 worth of tax and I have $2,500 worth of non-refundable tax credits, my tax payable will be zero, and I will not get a refund for that excess $500 in tax credits. A couple examples of some non-refundable tax credits is the basic exemption amount, the exemption for taxpayers with children, tuition, medical expenses, CPP deductions, and interest paid on student loans. Refundable tax credits can actually put you in a refund position. They're often available for anyone who qualifies for them, and they're often paid out over the course of a year. The most common refundable tax credit is the GST HST payment. That's paid out over the course of a year and is eligible for all families whose combined family income is less than $42,000. Now, a tax deduction works a little bit differently. Instead of reducing the amount of tax you owe, it reduces the amount of your taxable income. So therefore, you will pay less tax. One of the most common tax deductions is the RRSP contribution deduction, and people use that to put themselves in a lower tax bracket. The most common tax deductions are RRSP contributions, which I've talked about in a previous video, childcare expenses, union and professional dues, and donations to charity organizations and/or political parties. Now, if you look back at the tax calculator, you'll notice that there's different tax rates for different income types. You'll notice that the rates are lower for dividends and capital gains. It is true that investment income pays less tax than employment income. That's why it's a good idea to earn some income through investing. In today's video, we'll take a look at capital gains and dividends. So to start off, a capital gain is when you purchase a stock or another piece of property and then later on sell it for a price higher than the amount you paid for it. The most common example is with stocks. For example, if I purchased a stock at $10 a share and later on sold it for $30 a share, I would have a capital gain of $20. Canada would tax 50% of that gain, meaning $10 is taxable and reportable on my income return. So I would include that $10 as part of my taxable income, and then it would be taxed at my marginal rates. Also, if you have any capital losses, hopefully not, but you can report those against any capital gains that you've made over the course of the year. You can also carry back those capital losses for up to 3 years and carry them forward indefinitely. It's also important to note, and I've discussed it in previous videos, that any capital gains made in a tax-free savings account or an RRSP are not taxable and therefore are not reportable on your Canadian tax return. Now, a dividend, the official business definition of a dividend is a token reward paid to shareholders for their investment in a company's equity, and it usually originates from the company's net profits. Basically, what that means is the company that you're investing in is rewarding you and thanking you for your investments made in that company. What they do is they end up sharing in their profits, typically every quarter, and paying you what's called a dividend. Since the dividend is paid out of profits, the company has already paid tax on the income. So when you receive your tax slip for the dividends that you earned, you'll see there's a difference between the actual dividends and the taxable dividends. Now, the taxable dividends is always going to be higher by either 38% or 25%. That's because in Canada, there are two different types of dividends. There's eligible and non-eligible. And that has nothing to do with you, but everything to do with the Canadian corporation that you're investing in. Eligible dividends are grossed up at 38%, where non-eligible dividends are grossed up at 25%. A gross up is basically extra income to help offset any taxes you would have to pay. That way, the actual dividend amount is what you actually get to keep. So the gross up combined with the CRA dividend tax credit enables you to keep that money without paying extra tax. If you find yourself in one of the lower tax brackets, it's not uncommon to receive dividends tax-free. That's how taxes work in Canada for individuals. In short, higher income is always better. But the most important thing is not how much you earn, but how much you keep. I think it's important to spread your income over various income sources, especially employment and investments. Also, you want to take advantage of any tax credits and deductions. That was our crash course on Canadian taxes. I hope you enjoyed today's video and got a little bit more insight on how taxes work in Canada. If you got value out of this video, please give it a thumbs up and consider subscribing. Until next time, I'm out.